In this week's video, we'll cover the latest charts, data points, and historical studies that say the outlook for stocks and economy is much better than most believe. This is a chart of a breadth indicator that we covered on Friday, April 10th, 2020. At that time, we said this subtle little move right here told us to keep an open mind about the possibility that the low was already in. You can see here when the low was not in this case in 2008 and 2009, we never exceeded this level here. In a similar manner, 2011, 2012, this is what somewhat of a retest looks like here. This is a retest look here as well. Therefore, when we covered this chart on April 10th, there's certain things that we would expect to see if a low was already in place, and there are certain things that we would expect to see if we had a scenario like this. In this week's video, we will cover numerous charts similar to this chart here and see where we stand in the present day. These concepts apply to the next segment in the video. Truth is what you see. Opinions are what you hear. Facts are what you know. Reality is what you experience. Since there are approximately 2,800 companies listed on the New York Stock Exchange, if you're interested in tracking market breadth, any indicator tied to the NYSE composite is a good place to start. The upper portion of this chart shows NYSE stocks, the percentage of NYSE stocks above their 50-day simple moving average. On March 23, 2020, just a few short weeks ago, this indicator was down below 5%. This represents a market that's rarely oversold. And these headlines from March 23rd remind us that the economic outlook and sentiment was horrible down here on March 23rd, and that also applies to the data that we had in hand and/or the chart in front of us. Didn't look really good down here. How much has market breadth improved over the past few weeks when the market's been rallying? The answer is significantly. This indicator has moved from an extremely low reading down here below 5% all the way back to 88.91% as of May 26, 2020. Reality is what you experience. All of us have just experienced this. We've just watched the market move. And this move from this point here to this point here is something that we can see, measure, and put in a model. Therefore, it might be helpful to ask and answer. How many times has something similar happened in the past? We have data going all the way back to 2002, and relative to this rare oversold condition here, it's only occurred on 5 previous occasions. 2002, 2009, 2011, 2015, and late in calendar year 2018. These red boxes here are very, very similar to this point here. And these moves here, point A to point B, point A to point B, point A to point B, are very, very similar to reality in 2020. We just experienced this move. Similar and rare moves were only completed 5 previous times. There are no other cases on this graph. Completed in 2003, 2009, 2012, 2016, and 2019. These are the only cases where we moved from the blue line back to the green line. And since we know charts are a reflection of human behavior, and we also know that technical analysis tracks the past, it does not predict the future. You have to use your own intelligence to draw conclusions about what the past activity of some traders may say about the future activity of other traders. Where is the past activity of some traders on this chart? It's right here. This move from A to B. This is the past activity of some traders, something that we just experienced, every single one of us. And since this move in the present day is very similar to all 5 of these rare moves, The historical cases can give us some idea of what the past activity of some traders may say about the future activity of other traders. If we walked forward in each of these historical instances, so the green boxes are very, very similar to what just happened on May 26, 2020, which is a move from A to B. These are the 5 previous cases, and this is S&P 500 performance walking forward. For CCM clients, this extremely rare move here tells us something and reinforces something that we've covered in recent weeks, that given what we know today, we can start shifting gears back to more of a longer-term investor focus. And while a table like this may make things seem easy walking forward, given that 100% of the cases the S&P 500 was green 3 months out, 6 months out, 1 year out, 2 years out, 3 years out, 4 years out, and 5 years out. If you take a closer look at these numbers in here, it's not necessarily a cakewalk. In this instance, 6 weeks later, you were up 4%. 6 months later, you were lower, only up 3%. Even under the best of circumstances walking forward, it's extremely important to keep realistic expectations about 100% normal and to be expected volatility that even occurs within the context of the strongest historical trends. You may be thinking to yourself, that's great, that's one indicator. Well, since we use a weight of the evidence approach, think of this as data set 1. Data set 2, NASDAQ stocks greater than their 200-day exponential moving average. Very, very similar analysis. This is a rare move here. Has only happened a handful of times based on all the data we have going back to 2002. Same concepts here. This indicator is based on the S&P 500. S&P 500 stocks greater than their 200-day exponential moving average. This is something that we just experienced. Data set 3. NASDAQ stocks greater than their 50-day exponential moving average. Data set 4. Data set 5. NASDAQ 100 stocks greater than their 150-day simple moving average. Extremely rare move, only happened a handful of times looking in the rearview mirror. Data set number 6. NASDAQ stocks greater than their 150-day simple moving average. We just experienced an extremely rare move. Data set 7. NASDAQ 100 stocks greater than their 200-day simple moving average. Data set 8. NASDAQ stocks greater than their 200-day simple moving average. Here's the move in the present day. You can see a similar move here, 2002, 2003. Similar move here, 2008, 2009. Similar move, 2011, 2012. Similar move, 2016, and later in 2016. Late 2018, early 2019. All of those moves similar to this move here. And if you know your market history, this is the S&P 500. In each case, good things tended to happen walking forward. This is data set 8. Data set 9. NYSE stocks greater than their 50-day exponential moving average. Very, very similar concepts relative to this rare shift. This is data set 9, and this is data set 10. NASDAQ stocks greater than their 50-day simple moving average. The same concepts apply to all 10 data sets. And in every case, we moved from a very rarely oversold condition back to a much more constructive position. And in all 10 cases, the improvement in the data is something that we can all see, and it's something that we just lived through and experienced. We've all seen the market move in somewhat of a relentless fashion off of the low in recent weeks. We could have said something very similar right here, right here, right here, right here, and right here, which is very, very similar to May 26th of 2020. All of them featured ugly headlines and things to be concerned about when the market was rarely oversold. And all of them featured somewhat relentless moves from the rarely oversold condition. This is data set 1, the data set that we covered earlier in this segment. And this is the S&P 500 performance table for data set 1. Rather than cover 9 additional tables, let's look at a summary of all of the results and see what we can learn. Basically, the same concepts that we used in data set 1. All of the signals in the present day were flashed between May 22nd and May 27th, with most of them occurring closer to May 27th. Very, very recent and fresh signals. 10 signals and 10 charts in the present day. We have 43 historical cases that we can analyze. And the 43 historical cases help us draw conclusions about what the past activity of some traders may say about the future activity of other traders. Based on the 43 historical cases that are similar to the signals that we just witnessed in 2020, similar theme to what we've been covering in recent weeks, given what we know today, and that's extremely important, it's prudent for us under our approach to continue to shift to a longer-term focus. Why? In the historical cases, the market was higher in every case 1 year later, 2 years later, 3 years later, 4 years later, and 5 years later, with average gains of 19%, 36%, 46%, 57%, and 76%. And these numbers in here tell us that even if, and the emphasis is on if, because we're not forecasting anything here, even if good things happen, it's extremely important to have realistic expectations, because even the strongest bullish trends have normal and 100% to be expected pullbacks and counter-trend moves and corrections. Even when really good things happen, looking out 1 to 5 years, based on the 43 historical cases, there were plenty of examples where the market lost money between point A and point B in the first 6 months. One of the biggest reasons why investors have trouble making money in the stock market relates to unrealistic expectations about how markets operate in the real world. In the historical cases, the 43 historical cases, investors had to endure an average drawdown of roughly 4% and a median drawdown of roughly 3%. And if we examine all 43 of the historical cases, we can gain some additional insight. The good news is 70% of those cases, the maximum drawdown was less than 4%. 88% of the cases, less than 6%, 93%, less than 7%, and 95% of the cases, the maximum 6-month drawdown in the S&P 500 was less than 10%. When we start thinking about risk and reward, a 10% drawdown relative to a potential reward like this in the 43 historical cases is an acceptable and attractive risk-reward ratio. If we place these drawdowns hypothetically on a 2020 chart, here's our recent closing high up here. 95% of the cases, these cases here, this is what the drawdown would look like, the maximum 6-month drawdown on the present day chart of the S&P 500. If we look at the worst case scenarios from a historical perspective, we would still be making a higher low relative to the March 23rd low. It would look something like this. This type of move only occurred in 2 of the 43 historical cases, or 5% of the historical cases. In 95% of those cases, it was much more muted. Not a prediction about what's going to happen in the present day. It's It simply gives us some realistic guideposts based on history. As always, we'll learn something either way. If the drawdown gets into this area here and stays there for an extended period of time, then we'll learn something about bearish probabilities. But if the market backtracks in the coming days and weeks, number one, that wouldn't be surprising. It basically falls into we would expect to backtrack in the coming days and weeks based on history. And the natural inclination for human beings, if and when that happens, would be to take all of this and mentally throw it in the trash can and say it's wrong. Now, historically, that would have been a big, big mistake. If you kept your composure with this type of drawdown in the past, the reward was very, very satisfying. Thus, in all 43 historical cases, these historical drawdowns, these probabilities, and this maximum historical drawdown here on the 2020 chart, it helps us assess the probabilities relative to scenario 1, 2, and 3, and more importantly, relative to scenario 4. 3 out of the 4 cases are bullish in the long run. In every single historical case, after the drawdown or after some normal backtracking, really good things happen for a long period of time. The grand aim of all science is to cover the greatest number of empirical facts by logical deduction from the smallest number of hypotheses or axioms. And from those 10 data sets, 100% of the time the stock market was higher 1 year later, 2 years later, 3 years later, 4 years later, and 5 years later, which simply helps us keep an open mind about much better than expected outcomes walking forward as we trade the chart in front of us. Opinions and ideas are quite a bit different than provable facts. It really can't be debated that this just happened between the low on March 23rd of this year and May 26th of this year. And there's really no debating that there's only 5 previous cases on this chart. And it's not really debatable that in the 5 previous cases, good things tended to happen for a long period of time in the stock market walking forward. Now let's shift gears and cover some undebatable facts on the 2020 charts in front of us. Friday, May 29th, 3 p.m. Eastern, the S&P 500 has cleared and held above the 38.2% retracement based on this A to B move, the 50% retracement, and the 61.8% retracement. What does that tell us from a probability perspective? It's not atypical for a downtrend to retrace 38.2% of that type of move, 50% or 61.8%. Once you start to exceed the 61.8% level, it starts to put this downtrend in doubt from a probability perspective, and the probability of a new uptrend being in place increases. Therefore, all of this facts that we can see, measure, and put in a model as of 3 p.m. on Friday, May 29th. That tends to align with everything that we just covered based on the 43 historical cases, rather than contradict everything that we just covered in the 43 historical cases. Another thing that's not really debatable at this point, based on what we know at 3 p.m. on Friday, this is an uptrend. The market is making a series of higher highs and a series of higher lows. That absolutely positively may change, and it may change very, very soon, but it hasn't changed yet. And there's nothing magical about these levels here. If we backtrack into the levels, it really would not be shocking. That may or may not happen. It's something for the market to decide. How about a table like this and results like this? Does that align with a secular uptrend or a secular downtrend? The answer is easy, a secular uptrend. Price above an upward sloping 200-week moving average. 8th consecutive week that will be closing above an upward sloping 200-week moving average. Does that look more like a secular uptrend or a secular downtrend? The answer is secular uptrend, and secular uptrend would align nicely with everything that we've covered in this week's video. How about the fundamental side of it? We've been talking for several weeks about markets tend to bottom when really, really bad news gets less bad. A few weeks ago, we had a global economic shutdown. Today, the way to phrase it is the global economy was shut down. And think of it this way. If we had a factory or a business that was closed and our revenue or production basically went to zero, if we open our doors and produce anything, the data is going to go from very, very bad to less bad. Same thing with household outlays. Really nowhere to go but up. From Bloomberg, household outlays fell 13.6% from the prior month, the sharpest drop in Commerce Department records going back to 1959. And shockingly, maybe not shockingly if you do a lot of reading, income posted a record 10.5% increase. How is that possible? Federal stimulus payments. This speaks to pent-up demand. This speaks to consumers having money in checking and savings accounts. From an economic perspective, walking forward for the remainder of the year, how is it even possible that something like this could happen? From Politico, top former economic advisor to President Obama, we are about to see the best economic data we've seen in the history of this country. In early June, we will get the monthly employment report for the month of May. The next 4 reports could be blockbusters. You could easily have 1 to 2 million jobs created a month in those 4 reports before November. And then, toward the end of October, we will get GDP growth for the third quarter at an annualized rate, and it could be double-digit positive economic growth. So these will be the best jobs and growth numbers ever. Everything on this screen right here is really not getting a lot of coverage. The market seems to understand it, and it seems to be reflected in this move here. You can pause your video player for a little bit more detail, or better yet, Google to find the article on Politico. If something like this happens, how could the stock market go up? Talked about it last week. It's right here on your screen. And right here in early June, we're supposed to get another horrible monthly employment report. As we covered last week, in the real world, the best stock market performance occurs in the highest zone of unemployment, the weakest zone of real GDP, and the weakest zone of S&P 500 earnings growth. We just need to go from really bad to less bad. Something like this sounds less bad and quite a bit better. And whether or not we get a vaccine, that falls into the to be determined category, but there's absolutely positively no question that we're doing things in this area that we've never done in the past. CNBC article. In a 65-day window, researchers have isolated and identified the virus and begun testing a potential vaccine on humans. That has never, ever occurred before. You can pause your video player. Lots of stimulus in the economy. This relates to the EU. If you read a lot, I'm sure you read at some point that gyms and workout facilities would be one of the last businesses to come back. The early read, and it's an early read, 75% or more of members have already come back. Back to the technicals. NYSE common stock only advanced decline line. Holds here 2009, holds here 2016. This looked like a bearish breakdown. Now it looks like a failed bearish breakdown. S&P 500 on the bottom of your screen. In the previous cases, good things happen for a long period of time in the stock market. Simply speaks to probabilities. The probability of bad things happening relative to the probability of good things happening. The probability of really bad things happening is never 0. Normal caveat supply. It's important to have realistic expectations about normal and to be expected volatility. Nothing in this video is a prediction or forecast. We're simply making probabilistic statements based on the facts that we have in hand. If the facts change in a material way, we have to be ready, willing, and able to reassess those probabilities. All of this just helps us with really what the most important question is for an investor. And clients and regular viewers know the only way any of this works is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.